The current rate method and the temporal method are two different approaches used in the translation of financial statements of foreign subsidiaries into the reporting currency of the parent company. These methods are used in the context of foreign currency translation when a company operates in multiple countries and must consolidate its financial statements. Each method has its own set of rules for translating financial data, and the choice between them can significantly impact reported financial results. Current rate method. Exchange rate. Under the current rate method, all assets and liabilities are translated at the current exchange rate prevailing at the balance sheet date. Income statement items, such as revenues and expenses, are translated at the average exchange rate for the accounting period. Equity items. Common equity items, like retained earnings and common stock, are translated at historical exchange rates. However, if there are additional paid-in capital or other comprehensive income components, they may be translated using historical or current rates, depending on the company's policy. Income statement impact. Fluctuations in exchange rates can lead to gains or losses in the income statement, which can affect reported net income. Used when? The current rate method is typically used when the functional currency of the foreign subsidiary is the local currency, meaning the subsidiary's operations are closely tied to the local economy. Temporal method. Exchange rate. In the temporal method, different exchange rates are used for different types of accounts. Monetary assets and liabilities, e.g., cash, accounts receivable, and accounts payable, are translated at the current exchange rate, while non-monetary assets and liabilities, e.g., inventory, property, and equipment, are translated at historical exchange rates. Equity items. Similar to the current rate method, common equity items are typically translated at historical exchange rates, but there can be exceptions for certain components. Income statement impact. Exchange rate fluctuations can impact the value of non-monetary assets and liabilities on the balance sheet, and these fluctuations can affect reported gains or losses on the income statement. Used when? The temporal method is often used when the functional currency of the foreign subsidiary is not the local currency and there is a significant level of monetary assets and liabilities in a foreign currency. In summary, the key difference between the current rate method and the temporal method lies in the treatment of monetary and non-monetary items and the exchange rates used for translation. The choice between these methods depends on factors such as the nature of the subsidiary's operations, its functional currency, and the parent company's reporting preferences. It's important to note that the choice of method can have a material impact on the reported financial results of a multinational company, so it requires careful consideration and compliance with accounting standards like Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS.